There's a financial time bomb sitting inside the American banking system right now, and it has already started ticking. It is not hidden, it is not classified, it is not buried in some obscure regulatory filing that only insiders can access. It is sitting in plain sight in the quarterly earnings reports of hundreds of regional banks across the United States. And the mainstream financial media is either ignoring it or deliberately downplaying its significance. Because the moment the average American understands what is happening inside these banks, the confidence that holds the entire system together begins to crack. Here's what I need you to understand right now before we go any further. There is approximately $1.5 trillion in commercial real estate debt maturing in 2026 and 2027, $1.5 trillion. That is not a projection. That is not an estimate based on models. That is the actual dollar amount of commercial real estate loans that are coming due within the next 18 months, according to data from the Mortgage Bankers Association and TREP, which is the leading provider of commercial mortgage-backed securities analytics. These loans were originated during the zero interest rate era between 2019 and 2022, when borrowing costs were at historic lows, property valuations were inflated by cheap money, and lenders were competing aggressively to originate deals because the margins were enormous. Now, those loans are maturing, and the borrowers who took them out are facing a reality that is mathematically devastating. The properties backing these loans have lost 30 to 40% of their value in many markets. Interest rates have more than doubled since the loans were originated, and the income these properties generate has declined as vacancy rates have surged and rental rates have softened. The borrowers cannot refinance because no rational lender will issue a new loan at current interest rates on a property that is worth significantly less than the outstanding loan balance. They cannot sell because the market for commercial real estate has effectively frozen in many segments. And they cannot inject new equity because the returns no longer justify the investment. So what happens? They default. They hand the keys back to the lender. And the lender, which in the vast majority of cases is a regional or community bank, is forced to take ownership of a property that is worth far less than the loan it issued. That loss goes directly onto the bank's balance sheet. And for banks that are already strained by unrealized losses on their securities portfolios and operating with reserve requirements of just 3%, these commercial real estate losses could be the trigger that pushes them over the edge. This is not speculation. This is not a worst-case scenario that requires a dozen things to go wrong simultaneously. This is a mathematical certainty. The loans exist, the maturity dates are fixed, the property values have declined, the interest rates have risen, and the gap between what borrowers owe and what their properties are worth is unbridgeable. The only question is how fast the losses materialize and whether the banking system can absorb them without a cascade of failures. And here is the detail that makes the situation genuinely terrifying. Regional and community banks hold approximately 70% of all commercial real estate loans in the United States, 70%. These are not the too-big-to-fail institutions that have access to unlimited Federal Reserve support and implicit government guarantees. These are the banks in your town, the banks that hold your checking account, the banks that fund local businesses and process your mortgage payments, and they are sitting on a mountain of loans that are about to go bad. Over the next several minutes, I'm going to walk you through exactly how this crisis is unfolding sector by sector. I'm going to show you the data on office buildings, retail centers, multifamily properties, and hotels. I'm going to explain the mechanism by which commercial real estate losses cascade through the banking system. I'm going to show you why the tools that were used to contain previous crises are inadequate for this one. And I'm going to tell you what specific steps you should be taking right now to protect yourself, because the time bomb is not theoretical. It is ticking, and the fuse is shorter than most people realize. Let me walk you through the commercial real estate market sector by sector, because the damage is not uniform. Some segments are in outright collapse, while others are showing stress fractures that will widen significantly over the next 12 to 18 months. Understanding where the losses are concentrated tells you which banks are most exposed and which communities will be hit hardest. The office sector is ground zero. The work-from-home revolution that began during the pandemic has permanently reduced demand for office space in every major metropolitan area in the United States. According to data from CBRE, the national office vacancy rate hit 19.8% in the fourth quarter of 2025. That is the highest vacancy rate ever recorded. Nearly 1 in 5 office spaces in America is sitting empty. In some markets, the numbers are even more extreme. San Francisco is above 30%. Downtown Chicago is approaching 25%. Los Angeles, Houston, and Washington, D.C. are all above 20%. And here is why vacancy rates matter so much for the banking system. Commercial real estate loans are underwritten based on the income a property generates. When a building is 20 or 30% vacant, its income drops proportionally. But the loan payments don't drop. The borrower still owes the same amount every month. When the income from the property can no longer cover the debt service, the borrower has two choices. inject personal capital to cover the shortfall or default. For the first year or two, many borrowers chose to inject capital hoping that the market would recover, but we are now 3 years into this trend and the recovery has not materialized. Borrowers are exhausted, their capital reserves are depleted, and they are beginning to default in increasing numbers. According to TREP, the delinquency rate on office commercial mortgage-backed securities hit 8.5% in December 2025. That is more than triple the rate from 2 years earlier. And the trajectory is accelerating, not stabilizing. Every month, the number of office loans moving into special servicing increases. Special servicing is the stage where a loan is transferred to a specialist who manages distressed and defaulting loans. It is the last stop before foreclosure. But the office sector is not the only problem. Retail commercial real estate is under severe pressure as well. The shift to e-commerce has been relentless, and it accelerated dramatically during the pandemic. Major retailers have been closing locations across the country. According to Coresight Research, over 5,000 retail store closures were announced in 2025 alone. Shopping centers and strip malls that were already struggling are losing anchor tenants, which triggers co-tenancy clauses that allow smaller tenants to renegotiate their leases or leave entirely. The result is a cascading vacancy effect where the loss of one major tenant can destabilize an entire property. The retail delinquency rate on CMBS loans reached 6.2% in December 2025, up from 3.8% a year earlier. And the properties that are defaulting are not recovering their loan balances at sale. Loss severities on retail properties have been running between 35 and 50%. That means when a bank forecloses on a retail property and sells it, the bank recovers only 50 to 65 cents on every dollar it lent. The rest is a direct loss to the bank's balance sheet. Even the multifamily sector, which has been considered the most resilient segment of commercial real estate, is showing cracks. Overbuilding in many Sunbelt markets has created a supply glut that is pushing rents down and vacancy rates up. Cities like Austin, Phoenix, Nashville, and Atlanta saw enormous amounts of new apartment construction during the pandemic era, and that supply is now hitting the market at the worst possible time. Rents in these markets have declined 5 to 15% from their peaks. And for borrowers who underwrote their deals at peak rents with low interest rates, the math no longer works. The hotel sector is performing better than offices and retail, but it remains vulnerable to economic slowdown. Business travel has not fully recovered to pre-pandemic levels, and leisure travel, which surged in 2022 and 2023, is normalizing as consumers pull back on discretionary spending. Hotel loan delinquencies are running at approximately 4%, which is manageable for now, but will deteriorate rapidly if the economy enters a recession. When you add all of these sectors together, the picture is clear. The commercial real estate market is not experiencing a temporary correction. It is undergoing a structural repricing that reflects permanent changes in how Americans work, shop, and live. And the loans that were made based on the old reality are now backed by properties that exist in the new reality. The gap between those two realities is measured in hundreds of billions of dollars. And that gap is sitting on the balance sheets of regional banks across America. Now let me show you how commercial real estate losses cascade through the banking system, because this is the mechanism that transforms a real estate problem into a banking crisis, and potentially into a systemic financial crisis. When a commercial real estate loan defaults, the bank has to recognize the loss. Under current accounting rules, banks must write down the value of non-performing loans to reflect the estimated recovery value. If a bank issued a $50 million loan on an office building and that building is now worth $30 million, the bank has to take a $20 million write-down. That write-down comes directly out of the bank's capital. Bank capital is the cushion that absorbs losses and maintains the bank's solvency. For regional banks, the typical capital ratio is between 8 and 12% of total assets. A bank with $10 billion in assets might have $1 billion in capital. That sounds like a lot until you realize that a 10% loss rate on a $2 billion commercial real estate portfolio would wipe out 20% of the bank's entire capital base. And loss rates on commercial real estate in the current environment are running well above 10% in the most stressed sectors. But here is where the cascade effect begins. When a bank's capital ratio falls below regulatory minimums, the bank is required to either raise new capital or reduce its assets. Raising capital in the current environment is extremely difficult for regional banks because investors are aware of the risks and are demanding steep discounts. Many regional bank stocks have already declined 30 to 50% from their highs, which makes equity issuances massively dilutive to existing shareholders. Boards and management teams resist dilution, which means the alternative is asset reduction. Asset reduction means the bank pulls back on lending. It stops issuing new loans. It tightens credit standards. It calls in lines of credit. And it reduces its exposure to the sectors that are causing the losses. This is rational behavior for an individual bank, but when hundreds of banks do it simultaneously, it creates a credit crunch that amplifies the economic damage. Businesses that rely on bank credit to fund operations can't get financing. Commercial real estate borrowers who need to refinance can't find willing lenders. And the economy contracts further, which causes more defaults, which causes more losses, which forces more credit tightening. This is the deflationary feedback loop that central bankers fear more than almost anything else. And it is the same loop that turned the 2008 housing crisis into a global financial meltdown. The mechanism is identical, only the asset class has changed. In 2008, it was residential real estate. In 2026, it is commercial real estate. But the transmission channel through the banking system works exactly the same way. And here is the additional layer that makes the current situation more dangerous than most analysts are acknowledging. Regional banks are not just dealing with commercial real estate losses. They are simultaneously dealing with unrealized losses on their securities portfolios from the rapid rise in interest rates. According to FDIC data, United States banks were holding approximately $650 billion in unrealized losses on securities as of the third quarter of 2025. These are bonds that the banks bought during the zero-rate era that have declined in market value because interest rates rose. Now, technically, these unrealized losses don't affect the bank's regulatory capital ratios because, under current accounting rules, banks can classify these securities as held to maturity and carry them at book value rather than market value. But this accounting treatment is an illusion. If the bank needs to sell those securities to raise cash because depositors are withdrawing funds or because commercial real estate losses are depleting capital, the bank has to sell at market value, which means the unrealized loss becomes a realized loss instantly. This is exactly what killed Silicon Valley Bank. It had billions in unrealized losses on its bond portfolio. When depositors started withdrawing funds, the bank was forced to sell bonds at a loss to raise cash. The realized losses further spooked depositors, which accelerated withdrawals, which forced more bond sales at even steeper losses. The spiral took the bank from apparently solvent to collapsed in 48 hours. Now imagine that dynamic playing out across dozens or hundreds of regional banks simultaneously, each one dealing with commercial real estate losses that are depleting capital, each one sitting on unrealized securities losses that could crystallize at any moment, each one operating with reserve requirements of just 3%, and each one backed by an FDIC fund that has less than 1% coverage of insured deposits. The cascade potential is enormous, and the containment mechanisms are inadequate. So where does this leave you, and what should you be doing right now? Let me be very direct. Because the time for general observations and theoretical discussions is over. The commercial real estate maturity wall is not a future risk. It is a present reality. Loans are maturing right now. Borrowers are defaulting right now. Banks are absorbing losses right now. And the question is not whether this will affect the broader banking system, but how severe the impact will be, and whether you're positioned to survive it. The first thing you need to do is identify your exposure to regional banks. If you have deposits at a regional or community bank, you need to understand that these institutions are disproportionately exposed to commercial real estate risk. Pull up your bank's most recent quarterly report. Look at the composition of their loan portfolio. If commercial real estate loans represent more than 30% of total loans, that bank is carrying significant concentration risk. Look at their non-performing loan ratio. If it's above 2% and trending higher, the stress is already materializing. And check their capital ratios. If the Tier 1 capital ratio is below 9%, the cushion for absorbing losses is thin. I'm not telling you to pull all your money out of regional banks tomorrow. I'm telling you to understand where your money is and what risks it's exposed to. Knowledge is the first line of defense. If your bank has heavy commercial real estate exposure and deteriorating credit metrics, you should consider diversifying your deposits to other institutions that have less concentrated risk profiles. The second action is one I've discussed in previous videos, but it bears repeating because it is even more relevant now. Ensure that your deposits at any single institution do not exceed the FDIC insurance limit of $250,000. In a regional bank, failure uninsured deposits are at serious risk. They can be frozen for extended periods, they can take a haircut in the resolution process, and under bail and provisions, they can be converted into equity in the failing institution. The insurance limit exists for a reason. Use it. The third action is to continue building your position in assets that exist outside the banking system. Physical precious metals remain the most reliable form of wealth that carries zero counterparty risk. Gold has hit all-time highs repeatedly over the past year. And while I am not making a price prediction, I'm telling you that the central banks of the world are buying gold at record pace because they understand the risks building in the financial system. Over 1,000 metric tons purchased by central banks in 2024 alone. China has been adding to its gold reserves every single month. Russia, India, Turkey, Poland, and Singapore are all accumulating. When the institutions that run the global monetary system are aggressively stockpiling an asset, that tells you something about their confidence in the stability of the system they manage. The fourth action is to position yourself to take advantage of the distressed opportunities that will emerge from this crisis. When commercial real estate values collapse and banks are forced to liquidate properties at steep discounts, there will be opportunities to acquire real assets at prices that haven't been seen in a generation. But you can only capitalize on those opportunities if you have liquidity available. If all of your wealth is locked up in bank deposits or long-duration financial assets, you will be a spectator while others acquire valuable properties at 40 or 50 cents on the dollar. Maintaining a liquid reserve specifically designated for distressed asset acquisition is one of the most asymmetric strategies available in this environment. The fifth action is to reduce your overall exposure to the financial system's complexity. Simplify your holdings. Own things you understand. Avoid instruments with embedded leverage or counterparty chains that you cannot trace. In a crisis, the complex instruments fail first because nobody can accurately assess their true value or their true risk. Simplicity and transparency in your portfolio are not weaknesses. They are strengths that become increasingly valuable as systemic stress builds. Now here is my question for you, and I need you to answer this honestly in the comments. Is your primary bank a regional or community bank? And if it is, have you looked at their commercial real estate exposure? Have you checked their capital ratios? Have you verified that your deposits are within the FDIC insurance limit? I am asking because the data I've presented in this video is not abstract. It maps directly onto specific banks in specific communities across America. And the people who will be most affected by this crisis are the people who never bothered to check whether their bank was one of the vulnerable ones. If this video showed you something you didn't know before, share it with someone in your community who banks locally. They need this information. Subscribe and turn on notifications because I am tracking the commercial real estate maturity wall in real time. As loans mature and defaults materialize, I will be here breaking down the data and identifying which regions and which institutions are most at risk. The $1.5 trillion time bomb inside regional banks has started ticking. The fuse is burning. And the only question left is whether you will be standing at a safe distance when it goes off, or whether you will still be inside the building, wondering why nobody warned you. Stay sharp, stay informed, and stay ahead of the curve. I will see you in the next one.